Charlie Munger has recently warned about the possibility of a severe recession in 2024. Why is Munger so concerned? Could current issues like high inflation and excessive money printing be pushing us towards an economic downturn? How might these factors combine to create a challenging environment for the economy? What lessons can we learn from past economic bubbles and money printing episodes? And how could modern investing trends and technological advancements affect our financial future? Well, to know all about this, you have to stay tuned till the end. Charlie Munger, the renowned vice chairman of Berkshire Hathaway and partner of Warren Buffett, has recently raised alarms about the potential for a severe recession in 2024. Known for his deep economic insights and straightforward approach, Munger's predictions are always worth paying attention to. He has expressed concerns that current economic conditions, such as rampant inflation and unprecedented levels of money printing, could culminate in a significant economic downturn. What exactly does Munger foresee, and what are the broader implications of his warnings? Let's talk about that in detail. Inflation, a central concern for Munger, is a key economic indicator that measures how prices for goods and services increase over time. When inflation is high, the value of money decreases, meaning you can buy less with the same amount of money. For instance, if inflation's at 5%, a $100 item today will cost $105 next year. Historically, high inflation has led to economic instability, and Munger believes that we are at the brink of experiencing such instability again. The U.S. Consumer Price Index, or CPI, which tracks the average change in prices paid by consumers for goods and services, provides a snapshot of inflation. In 2021, the CPI increased by 7%, the highest annual rate since 1981. This surge in inflation was partly driven by supply chain disruptions and increased demand following the COVID-19 pandemic. If inflation continues to rise unchecked, it could erode purchasing power, leading to decreased consumer spending and potential economic contraction. Munger is also worried about the formation of an economic bubble, which occurs when asset prices are inflated beyond their intrinsic value. Economic bubbles are typically driven by speculative behavior, where investors buy assets not based on their actual value, but on the hope that prices will keep rising. These bubbles can burst, leading to sharp declines in asset prices and economic downturns. The dot-com bubble of the late 1990s serves as a prime example. During this technology period, technology stocks soared as investors speculated on the potential of internet companies. However, by 2000, the bubble burst, leading to a significant market crash. Similarly, the housing bubble of the mid-2000s, fueled by subprime mortgages and risky lending practices, culminated in the 2008 financial crisis. Munger believes that the current economic environment exhibits signs of a bubble driven by massive monetary stimulus and speculative investments. One of Munger's primary concerns is the scale of money printing by governments and central banks. Money printing, or increasing the money supply, is often used as a tool to stimulate economic growth, especially during times of crisis. However, if not managed carefully, it can lead to inflation and economic instability. To illustrate, during the 2008 financial crisis, the U.S. Federal Reserve implemented a policy known as quantitative easing, or QE. QE involved purchasing government bonds and other securities to inject liquidity into the financial system. By 2015, the Fed's balance sheet had expanded from approximately $800 billion to over $4.5 trillion. While QE helped stabilize the economy, it also raised concerns about future inflation and potential economic overheating. In contrast, Munger points to the example of Zimbabwe, which experienced hyperinflation in the late 2000s. At its peak, Zimbabwe's inflation rate reached 89.7 sextillion% per month in November 2008. Hyperinflation rendered the Zimbabwean dollar virtually worthless and led to severe economic and social consequences. Munger often references Paul Volcker, who served as chairman of the Federal Reserve from 1979 to 1987, as a contrast to current monetary policies. Volcker is renowned for his aggressive measures to combat the high inflation of the 70s. He raised the federal funds rate to as high as 20% in an effort to control inflation, which led to a deep recession, but eventually brought inflation under control. Volcker's policies were harsh but effective. They demonstrated the potential for high interest rates to combat inflation, albeit at the cost of short-term economic pain. Munger questions whether modern policymakers would be willing to implement similar measures, given the current political climate and the potential backlash from both consumers and businesses. Munger's concerns extend to the possibility of a severe recession, which could be more profound than previous downturns. Historical recessions, such as the Great Recession of 2008, were significant but manageable compared to the potential risks Munger foresees. The Great Recession of 2008 triggered by the collapse of the housing market and the ensuing financial crisis, led to widespread unemployment and economic hardship, but was eventually addressed through monetary and fiscal policy measures. In contrast, Munger suggests that the combination of extreme inflation, massive debt levels, and economic distortions could result in a more severe and prolonged recession. For example, the global debt to GDP ratio reached approximately 355% in 2020, according to the Institute of International Finance. This high level of debt, coupled with rising inflation, could exacerbate economic challenges and lead to a more severe downturn. Munger's forecast also includes concerns about the impact of passive investing on stock markets. Passive investing involves investing in index funds that track market indices like the S&P 500, rather than actively picking individual stocks. This approach has become increasingly popular in recent years, with assets in passive funds surpassing $10 trillion globally by 2021. Munger argues that the rise of passive investing has led to a concentration of market power in a few large fund managers such as BlackRock and Vanguard. These fund managers now control a significant portion of the market, influencing corporate governance and stock valuations. For instance, as of 2022, BlackRock managed approximately $9 trillion in assets, making it one of the largest asset managers in the world. Munger believes that this concentration of power could lead to market distortions and affect the health of the financial system. When a few large players hold substantial shares in many companies, it can create imbalances and increase systemic risk. This concentration could also impact corporate decision-making, as fund managers might prioritize short-term returns over long-term growth. Technological advancements, particularly automation and robotics, are another area of concern for Munger. Automation has transformed industries by increasing efficiency, but has also led to significant job displacement. In the manufacturing sector, for example, automation has streamlined production processes but reduced the need for manual labor. The Chinese government's invested heavily in automation and AI, aiming to transition from a low-cost manufacturing hub to a high-tech powerhouse. According to a report by McKinsey, up to 30% of U.S. jobs could be automated by 2030, potentially leading to significant economic and social changes. Economic strain can also have psychological and social effects. Munger reflects on how previous generations faced significant hardships, such as during the Great Depression, when survival was a daily struggle. A study by the World Health Organization found that mental health disorders account for approximately 13% of the global burden of the disease. This underscores the impact of economic and social factors on the mental well-being and highlights the need for supportive policies and resources to address these issues. In light of potential economic challenges, Munger advocates for a long-term investment perspective. His investment philosophy emphasizes the importance of investing in high-quality assets and maintaining a disciplined approach. Berkshire Hathaway first invested in Apple in 2016 and has since seen significant returns as Apple stock prices increased. Munger believes that focusing on quality investments and avoiding the temptation to time the market based on short-term fluctuations can lead to long-term success. Investing in companies with strong financials, competitive advantages, and solid growth potential can provide stability during economic downturns.